In less than a month, the NASDAQ 100, which includes many of the world's largest companies, fell by more than 10%, astonishing investors. However, this shock might not have been so unexpected given some of the developments in the past 2 years. Warren Buffett, the world's most famous investor, has been amassing a significant cash reserve since around 2017. This buildup has accelerated in recent years. Although he hasn't explicitly stated his reasons, Buffett is known for expressing his views through his actions rather than his words. This raises a question. Does he know something we don't? Should we brace for this recent downturn to spiral into a major recession? I think we all know the answer, but to illustrate it, we need to take a brief look back at history and understand some key aspects of the global economy. In 2007, we experienced a major recession which led the Fed to lower interest rates to nearly zero for about 10 years. Interest rates function like gravity in an economy. Set them to zero and everything, including housing, land, and stocks, will begin to float up to absurd valuations. Starting in 2016, the Fed gradually began raising rates to return them to more normal levels, but before they could make significant progress, we all know what happened in 2020. To combat the complete pause of the American and global economy, the Fed took unprecedented action, lowering rates back to zero and printing trillions of dollars, injecting them into the economy like a massive dose of drugs to revive it and create a euphoric effect. And of course, this worked. Stocks surged and home values skyrocketed. But the euphoria came at a cost. Inflation began to rise and the Fed responded with significant interest rate hikes. So what does all of this have to do with Buffett? Well, we all know Buffett has made his fortune by buying deals and is willing to wait decades for the right opportunities. And he's made it pretty clear through his actions that we are currently living in the middle of the world's biggest stock market bubble. Why do I believe this? Well, look no further than the Buffett Indicator. The way it works is pretty simple. Divide a country's GDP, which measures total economic output, by the stock market's total value. Plot this on a chart, add some standard deviations, and you have a straightforward way to judge market bubbles. Currently, we're at absurd levels. Just how absurd? Insanely absurd. In 2019, the market was already in overvalued territory. By 2022, we reached an all-time high just before a major market pullback. However, just as quickly as we fell, we bounced back and now find ourselves once again approaching these absurd all-time highs. Buffett understands that the market cannot sustain this continuous push, which is why he's making strategic moves like building a cash pile. He is careful to never let his words influence the market and change its dynamics, so you won't ever find a clip of him explicitly stating that the markets are overvalued and primed for a crash. However, if you listen closely, you can read between the lines. For example, at the last Berkshire meeting, when he was asked why he sold off a significant portion of his valuable Apple stock, his answer might surprise you. Take a listen.
Let's start, just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions. And you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now.
That may have sounded like nothing, but if we break down what he said and combine it with his actions at the time, we can gain a better sense of what Buffett is thinking and what we can expect in terms of a market crash in the coming year. Berkshire has always maintained some cash reserves, but this recent buildup is no coincidence. As I write this, the Berkshire portfolio consists of $298 billion worth of equities. Their cash pile after this massive Apple sale is now $276 billion. This means that 48% is currently in cash equivalents. When you compare this with the Buffett Indicator, it becomes clear that Buffett sees no positive outcome from this recent market surge. He has been accumulating cash since the late 2010s, just as the Buffett Indicator was creeping up. In 2022, we saw a massive run-up, which many called a super bubble, followed by a significant implosion in prices, with the S&P 500 falling by 25%. This seemed to alleviate the issue somewhat, but even back then, when we were nearly 2 standard deviations above normal levels, there was a sense of panic. To make matters worse, economists had a legitimate excuse at the time. Interest rates were very low, which acted as a catalyst for these prices. While this didn't invalidate the Buffett Indicator, it masked some of the clear health problems the market had simply because money was very cheap. Now climbing back to the same heights in a high rate environment makes this much worse than it was just 2 years ago. These recent developments are likely what Buffett is considering when selling off massive winners like Apple, which he held for years. This is the end of the road, and Berkshire will look to capitalize when this indicator retraces to more normal levels. Long story short, Warren is looking for and expecting a crash sometime soon, and he wants to be well prepared to scoop up the deals after the pieces shatter. While we're on the topic of interest rates and market dynamics, there's compelling evidence explaining why company stocks soared in recent years and why they're now plummeting. The market thrives in a low interest rate environment. However, with the recent rate hikes, many were puzzled by the massive gains, despite the 10-year yield, a benchmark for rates, climbing higher. Did we just achieve the greatest soft landing of all time? The answer is no. It turns out another country was subsidizing the pain for us. I'll keep it simple to avoid overcomplicating things. You see, some time ago, Japan faced a major issue: persistent deflation. While falling prices might sound great for consumers, it's disastrous for an economy. To illustrate how much governments hate deflation, consider this. In the 1930s, the US government paid farmers to kill livestock and burn crops to artificially reduce supply and increase prices. In Japan, they use more conventional methods, including keeping interest rates near zero. Since about 1999, the Bank of Japan has maintained essentially zero interest rates, only raising them briefly in 2003 and 2008. Despite these efforts, they couldn't eliminate deflation and even experimented with negative interest rates, a bizarre concept. This situation created a unique opportunity for overseas investors who could borrow money in Japan at very low rates, essentially for free. This wasn't a big deal when US interest rates were also near zero. However, recently, the Federal Reserve has raised rates significantly, and this is where it gets interesting. Big-time investors discovered a simple strategy: borrow in Japan, convert that money to US dollars, and invest in US treasuries, making a virtually guaranteed profit, a classic arbitrage play. To boost their profits, these investors realized they could amplify these gains by borrowing more than what they were putting down in Japan and using that extra loaned out money to buy big-name tech stocks like Nvidia in the US with additional leverage. Essentially, they were using double leverage. This strategy was working great, allowing investors to print money and circumvent the high rates in the US. However, there's a big warning with this trade. It only works if the yen, the Japanese currency, stays level or drops. Over the years, due to excessive printing, low rates, and loan abuse, the yen has consistently fallen, spiraling downwards since about 2011. But if the yen goes up for any reason, the whole trade implodes. Investors are then forced to liquidate and sell their stocks to pay back their loans in Japan at unfavorable conversion rates on top of equity losses. Well, guess what happened? The yen went up against the dollar by 11% this past month, and the whole house of cards began to implode. The Japanese, simply trying to save their currency, are fighting back, and now the whole system is in danger with sky-high valuations. Every day is now a battle against potential sparks, and it only takes one to light the whole thing on fire. Warren knows this, the world knows this, and now is just a matter of time before an equity crash brings us back to more normal valuations, reducing the Buffett Indicator to undervalued territory at the expense of the US economy. Let me know what you think in the comments below. Is Warren really just cashing in on his gains, or is he preparing for a massive crash led by the Japanese carry trade? Don't forget to like and subscribe, and while you're at it, check out my Amazon affiliate link in the description if you want to support the channel.